Hello everyone, I'm Andy Wong. The US stock market has seen stocks breaking highs on... Check out our weekly economic chart review. This teaching session does not contain any investment advice. Don't forget to subscribe to our YouTube channel, like our video, and share it with your friends. If you're exploring US interest rate cuts, watch the labor market data. Recent labor market data seems slightly worse than market expectations. Non-farm payrolls have picked up since October. Remember to subscribe to our YouTube channel, like our video, if you're exploring US interest rate cuts. Watch the labor market data. Recent data is slightly below expectations, but it's a short-term dip. Non-farm payrolls have been rising since October. Previously, large companies supported the labor market, but many started layoffs mid-year. Now, small and medium enterprises in the US are hiring. This is a short-term dip, slightly worse than expected, heading in a negative direction. Overall, no real danger signals yet. On the left of the chart, non-farm payrolls have risen since October due to events like weather. On the right, the market is watching closely. Support for the labor market came from large companies, which started layoffs mid-year. Now, small and medium enterprises in the US are hiring. The labor market data is decent medium term, with no dangerous signals. This could lead the Federal Reserve to cut rates in December. A 75 basis point cut this year might suffice, with 3 cuts possible next year. In the past, the labor market was often supported by large companies, and you might have heard that many large firms started laying off employees around mid-year. However, now they're looking at small and medium-sized enterprises in the US, which are actually willing to hire people. So overall, the labor market data, from a medium-term perspective, is still quite decent. And I don't think there are any particularly dangerous signals at the moment. This situation could lead the Federal Reserve to cut rates in December. A 75 basis point cut might suffice, and next year 3 cuts are possible. The market is pricing in a December cut and possibly 2 next year. This pace is more normal compared to last year's market view. If you noticed when the US 10-year Treasury yield hit 4.4%, we mentioned considering buying. The yield has since dropped to around 4.15%. It should be quite sufficient now, and the current market is pricing in a significant chance of a rate cut in December. Then next year, people are also expecting possibly 2 rate cuts. For now, I think this pace is much more normal compared to the market's view from a year ago, and it aligns more closely with what we've been sharing with you all along. During this time, if you noticed when the US 10-year Treasury yield hit 4.4%, we mentioned considering buying. The yield has since dropped to around 4.15%. The US economy is stable, so unless unexpected events occur, a sharp drop in the 10-year yield is unlikely. It will likely remain range-bound. The US stock market seems dull as it feels stagnant. However, the S&P 500 broke its previous high last week and continues from last week's closing high. Actually, the current situation isn't too bad for the US economy, so unless there are any black swan events or significant uncertainties, we believe the chances of the 10-year Treasury yield dropping sharply again are quite low. It's more likely that we'll start to see it range-bound for a while. So it sounds like the US stock market doesn't have much news. As I mentioned last week, it seems like the US market is in a bit of a dull phase. However, if we take a look again, starting with the right side of the chart, we can see that the S&P 500 actually broke through its previous high last week. Now, it seems to be continuing from last week's closing high. After another 5 days, we're seeing an upward trend. It aligns with earlier technical analysis, fitting into an upward channel with past pullbacks and breakouts. Everything is technically in sync. The media hasn't introduced many new topics, making it feel less exciting. Looking at this, in the Hang Seng Index, I tell colleagues to focus on usual fundamental analysis unless a specific client story is needed. I prefer a neutral or slightly greedy sentiment. This situation is preferable as it shows we're not in a speculative phase, but in a stable state, possibly rotating and reflecting different fundamentals. Right now, as mentioned, fundamentals show a positive trend. In the Hang Seng Index, I often tell my colleagues that unless we need to tell a specific story to clients, we should focus on the fundamental analysis. We usually do. In fact, I prefer to see a more neutral or slightly greedy sentiment. This kind of situation is preferable because it reflects that we're not in a speculative phase. but rather the market is in a more stable state. It's a bit mediocre here, possibly reflecting different fundamentals through rotation. And the current fundamentals, as we've mentioned before, are still showing a positive trend. As for the rotation, I mentioned earlier, since the US elections in November, we've already seen several instances of rotation. There was a time when small and mid-cap stocks, represented by the white line for mid-caps and the blue line for small caps, were performing quite well. However, as we've discussed before, after breaking through, will there be some pullbacks? Right now, it seems like they are taking a break and doing some pullbacks, just like we saw earlier. With the S&P 500, it's showing better performance now. So overall, it seems like. But we think that the US stock market is just a rotation among large cap, mid cap, and small cap stocks. So let's take a look at how the S&P 500 has performed over the past week across different stocks and sectors. I believe you'll quickly notice that overall, some of the big names in the US tech sector seem to be performing better. One point I want to highlight is that while we refer to them as tech stocks, it's important to pay attention to the fact that different sectors might have some variations, even though they are all tech stocks. For example, Amazon and Tesla might be categorized under the non-essential consumer sector. This point is really important, and I will continue to discuss it in this episode. The US stock market is experiencing a rotation, with big tech stocks performing well recently. Let's examine the MAGS ETF, which tracks the top 7 US tech stocks. Its performance over the past 2 weeks has outpaced the average weighted index ETF, the RSP. Its relative performance is stronger, and within the top 7 tech stocks, new highs were reached last week. Regarding rotation, let's review each sector. Non-essential consumer goods, some communication services, and tech sectors have excelled, while others lagged. Within non-essential consumer goods, many funds have favored this area. In addition to the strong relative performance, you might have noticed that the top 7 tech stocks in the US actually reached a new high over the past week. In terms of rotation, let's take a look at each sector one by one. I believe you all have noticed that in just this past week, sectors like non-essential consumer goods, some communication services, and technology have performed quite well, while others have lagged behind. In this interesting scenario, within the non-essential consumer goods sector, we've actually noticed that a lot of funds have been favoring this area during this time. If you've been following our content, you might have noticed our weekly ETF reports. We use signals from unusual fund flows to gain insights into sectors or ETFs. If we want to chase certain sectors or trends, will we have more confidence? This week we highlighted the IYC, the US non-essential goods ETF, which appeared in fund flow signals. Last week we noted a risk-on scenario in the ETF report. This past week, rates increased despite dull news themes. While the US stock market hit new highs, we use these fund flow signals to understand market happenings. Will there be more confidence? Or in chasing certain sectors or trends, consider essential versus non-essential consumer goods. This week we highlighted IYC, an ETF for non-essential US goods appearing in fund flow signals. Mentioned last week, ETF report showed a risk-on scenario and increased REITs. Despite dull news, US stock market hit new highs. Fund flow signals help understand market trends, boosting confidence, judgments and operations. Returning to non-essential sector, IYC was in our ETF report. XLY is another example. Sector rotation shows commonalities. In the ETF report, we observed a risk-on scenario, and last week, REITs increased. Despite dull news, where stocks hit new highs, we use fund flow signals to understand market dynamics. This strengthens our confidence and assists operations. In the non-essential sector, note IYC in our ETF report and XLY as examples. Sector rotation shows commonalities, with Amazon and Tesla significant in XLY, nearing a 40% increase. Also, consider companies like McDonald's, and within IYC, Costco and Home Depot, these trends are evident. We can boost our confidence in our own judgments, and it might even help with our operations. Now, going back to the non-essential sector. One thing to note is that the IYC was part of our educational sharing in the ETF report, while XLY is another example. If we look at the sector rotation, you'll see some commonalities. Amazon and Tesla are significant in this sector, especially in XLY, with both stocks nearing a 40% increase. Also, consider companies like McDonald's, Costco, and Home Depot. Within IYC, these trends are evident. Funds are flocking to this sector, possibly due to low base effects or Trump's policies. Let's focus on Amazon and Tesla's recent performance. Amazon's technical trend is strong. During the earnings period, Amazon's results were impressive, driven by cost control and management actions. Let's pay attention to why funds are flocking to this sector. This might be something you can delve into, considering whether there are some low base effects at play. Additionally, it could also be related to some of Trump's policies, but let's not get too far into that today. Instead, let's focus on the recent performance of these two heavyweight stocks, Amazon and Tesla. So, regarding Amazon's technical trend, I believe everyone can see that it's quite strong. You can look back to the earnings period when we discussed that Amazon's results were actually impressive. I remember sharing on the show that this time Amazon's earnings were driven by three engines working together, including some cost control measures and actions taken by management over the past period. Now we present our homework. It was $190 and it is now $227. US consumer power and online sales during Black Friday contributed. Also, there's cloud computing and AI-related developments. A key focus is the AI chip sector, where they have shown effective cost management. This AI focus may explain stock price pressure. In the short term, this gap serves as resistance, useful for risk management. In the AI chip sector, they have once again shown how they effectively managed costs to drive the company's development in that direction. This focus on AI development could explain why their stock price has been experiencing some upward pressure. So in the short term, I believe that besides this recent upward gap, it also serves as a short-term resistance level, which can be used as a reference for risk management. It is also the latest short-term top, a support, and can be used as a reference for the next risk management. As for the other stock, that's Tesla. Before the US elections, when Trump hadn't won yet, there was a lot of talk about Trump trades. At that time, we emphasized that we didn't think Tesla was part of that Trump trade. However, after Trump actually won, we started to see a clear Trump trade emerging for Tesla. So, among all this, there are definitely other themes related to Tesla's pricing during this time. Overall, we can see that this week, one of the catalysts might be that many major firms have finally raised their target prices back up to historical highs, around $400 or about $420. Recently, many major firms have adjusted their target prices upwards, and I think that might actually be. Recently, there have been many topics related to AI software applications that people are optimistic about. Tesla's FSD is something the market is starting to chase more boldly now. It has been rising quite rapidly lately. Some stocks might not align with their valuations, but focusing on the optimistic aspects, those following our discussions on Tesla can feel the emergence of its second wave of ecosystem. We talked about the first wave, and now the second wave is starting to roll out. We placed it on our Patreon platform. Thanks for your support. Well, everyone understands that if the fundamentals don't align with the stock's valuation, that's one thing. But if we're just thinking about some optimistic prospects, I believe those who have been following our discussions on Tesla can feel the emergence of its second wave of ecosystem. A few years ago, we talked about the first wave, and now the second wave is officially starting to roll out. It seems like this development is just beginning now. In the earlier sharing about the ETF fund flows, we placed it on our Patreon platform. But remember, we also have IG and Facebook, so don't forget to subscribe to us. This chart, I really haven't updated it because from the first time I told you how many new media platforms we have, it has certainly increased since then. Thanks for your support. I hope everyone can actively introduce this to more friends. The market favors AI themes. The focus was on chip-related hardware, but now there's more interest in software applications. During earnings season, people examine which companies are growing or recovering, check details or follow shares on now. Among AI application companies, some are doing well, but the space is highly competitive. it's hard to say any have a strong competitive moat. During this earnings season, people are starting to take a serious look at which companies might be experiencing rapid growth or are in a recovery phase. One example is Salesforce CRM, which we discussed in an interview on Now TV. You can check out the details. Among these AI application companies, some are thriving, but the AI application space is fierce. None have a strong moat. How do we navigate this? How do you make your product appealing for users to stay and pay more? These are key future points. No matter the story, results are needed. We are far from harvest. It's just the start. You can refer back to some shares on Now. Among these AI application companies, some seem successful now, but ultimately this AI application space is very competitive. I believe that right now, it's hard to say that any of them hold a strong advantage. So the question is how to make your product appealing for users to stay and pay more for AI services. These are future key points. Regardless of a company's story, they must deliver results. We're far from the harvest period. It's just the start of development. You can refer back to our shares on Now. How can your product or service make users willing to stay with you and even pay more for your new AI services? These are the key points for the future. So no matter how great a company's story is, in the end, they need to start delivering results. I think we're still far from the harvest period. Right now, it's just the beginning of their development. You can refer back to our shares on Now. Let's go to the sharing on Now. And there's also something else. In the interview on that day, there was a sharing about IGV. The reporter asked, if we look at topics related to AI, how can we pair them up? I mentioned that you can think about some EDF topics, especially in the recent ETF reports that everyone can refer to. In the previous editions, one of the ETFs that saw a movement in fund flow is IGV. There are many companies in it, especially CRM, Salesforce, having the largest weight. Other companies like Oracle, ServiceNow, Microsoft, Adobe, Planet are well known in AI. There's unusual fund flow activity. So when people say the market is dull, I disagree because we've been mentioning topics in rotation and fermenting, but they don't seem new. For example, SpaceX, because DXY after Trump won on November 6th, we mentioned DXY could benefit. Maybe it's because of this that there will be some changes in the flow of funds. So it's so popular. But this is just a follow-up, a teaching and sharing. Follow up on what's coming. When people say the market is dull, I disagree. Recently, we've discussed topics in rotation like SpaceX, which are fermenting but not new. For example, after Trump won on November 6th, we noted DXY as a potential theme. The candle was strong, moving from $10 to over $60. People focus on SpaceX, Elon Musk, and Trump, but SpaceX has positive news. Starlink might offer mobile services not like old satellite phones, but regular smartphones. This new model, once imagined, is becoming reality. The bullish candle rose from $10 to over $60. Focus is on SpaceX, Elon Musk, and Trump. SpaceX has positive news. Starlink may offer services via regular smartphones. Unlike movie satellite phones, regular smartphones can connect now. This new model, once imagined, is becoming reality. Some suggest separating Starlink. They are aiding SpaceX with new valuations. Estimates rose from 210 to 250. This increase is significant. DXY. Can the receive services be put into full play? And this mobile phone is not like the satellite phones we used to watch dramas, but it is an ordinary mobile phone, even today's smartphone, which can actually be connected to it. A possibility, it's a new model. This is a scenario that we have imagined with everyone for a long time. And now we are realizing it step by step. Yes, actually, because some suggest separating Starlink, they're aiding SpaceX's valuation, which rose from 210 to 250 in months. This is significant. DXY basics and private equity complicate premium assessment. Be cautious. This product has risks beyond typical ETFs. This week's news, Bitcoin broke 100,000 but hovers there. Technical analysis may outweigh fundamentals for Bitcoin. I saw a Bloomberg chart. You only have basic but also private equity. There are many other shares in it. It's hard to figure out how much more expensive this premium system is. I just want to be careful. This system. The risks of this product come from the teaching. I must mention that this risk is not just the risk of ordinary ETFs. This is something that we should pay attention to. All right, so this week's news topic is Bitcoin because it finally broke through the 100,000 mark, but now it's kind of hovering around that level. Overall, I think when people think about Bitcoin, technical analysis might be more important because it's harder to measure the fundamentals. To some extent, I agree with that, but I happened to see a chart on Bloomberg that talks about categorizing the factors affecting Bitcoin. Speaking of which, if we categorize the factors affecting Bitcoin, what might they be? Right now, one of the major influencing factors seems to be news from the Federal Reserve, which is currently quite sensitive to Bitcoin's price. So, in the near future, we might need to pay a bit more attention to news related to the Fed. What is this? That's the situation with Bitcoin. And when you think about Bitcoin and crypto, everyone will think about it. And they should think about the financial technology we mentioned because we talk about it all day long. Well, even Bitcoin, blockchain, and the like are actually viewed from the perspective of an ecosystem. From this point of view, you actually have seen, for example, RKF before. Phoenix is like, since then, when it was first brought up, the trend hasn't really changed much. For now, there aren't any warning signs telling me to get out. So the trend is still looking good. This is just a follow-up for review. Alright, so coming up this week, even though it seems like people are mentioning earnings season less, there are still some stocks we should keep an eye on, like Oracle, Adobe, Broadcom, and Costco. These are all big names, and they're companies that everyone tends to pay attention to, so make sure to check them out. On another topic, during this time, the gold price has rebounded and is consolidating. It's near the bottom of the upward trend channel, and news says China is increasing its gold reserves again. Could this change gold's trajectory? It's worth watching. During this consolidation, there might be a double bottom or higher low scenario. Let's see if it holds the channel. Regarding China, we need to discuss trends in the Hong Kong and China stock markets. Fundamentally, no major updates as everyone awaits the economic meeting for news. I previously marked a support range in green, and money seems to be flowing in there. Some buying has been happening almost unnoticed. If that's the case, it's worth noting that during this consolidation period, there might be a chance for a double bottom or even a higher low scenario. Let's see if it can really hold this upward channel. Alright, speaking of the situation in China, we definitely need to talk about the recent trends in the Hong Kong and China stock markets. Fundamentally, there haven't been any major updates, because everyone is waiting for the upcoming economic meeting to see if there will be any news. Interestingly, I had previously drawn a support range for you, marked in green, and it seems that money has already started to flow in around that area. In fact, you could say that some buying has been happening almost unnoticed. Well, it's looking a bit better. Henry also mentioned in his technical analysis that in the short term, there's a bit of a head and shoulders pattern forming. Plus, if we look at the city, the right shoulder needs to break through the downward trend line from the last 2 months. So there's a bit of hope there, a bit of optimism about this technical trend. There might already be some early signs of spring in the market, meaning things are starting to brew. We'll keep an eye on how the situation develops later on. Alright, so coming up this week, it might actually be a bit busier at the start because, for example, we'll see data from the housing market in Australia and also the RBA's interest rate decision. As we know, among mature markets, Australia has been a bit slow and is still maintaining high interest rates. Plus, Australia is already starting to get into holiday mode, so I believe things seem quieter this week. People watch Japan. Their market focuses on rate hikes. Watch closely. China's CPI data is key. Updates may come. In the US, CPI is less urgent. Focus on the labor market. Is the situation unchanged? Are there signs of labor market cooling? How's the loan situation? As for the US, I personally think that while we should pay attention to the CPI, it might not be that urgent. The most important thing is to look at their labor market. Is the situation still continuing as it has been? After all, we've already passed Thanksgiving and Black Friday, Will we start to see any signs of cooling in the labor market? These are the points to keep an eye on. All right, that's it for today. Thank you all for your support as we wrap up this sharing.